All right, we begin in Nigeria. President Bola Tinubu has signed into law the Investment and Securities Act, that's the ISA 2025, marking a major milestone in Nigeria's capital market reform. You can see some highlights there. Repealing the prior act of 2007. We're going to define what a composite and non-composite exchange means because those categories are in the act. It also brings digital assets under security purview. I think we're going to start there with our guest in Abuja. And also subnationals have more flexibility with capital raising. But does that mean that there could be looser rules around that? Could that be like a moral hazard? Stricter penalties for financial crimes, including pyramid schemes. That's right. Let's talk to Professor Uche Uwaleke, Director, Institute of Capital Market Studies in Nasarawa State University, KEFI, and the President of the Capital Markets Academics of Nigeria. Professor, good morning to you. Happy Eid. Great to see you this morning. Thanks for joining us. So, big picture, what is the significance of this act to Nigeria's capital markets?
Yeah, thanks so much, Rotus. Compliments of the season. Now, you've rightly said it. It's indeed a milestone in the history of the Nigerian capital market. If you look at the defunct law, was done in 2007. And since 2007, that's nearly 20 years now, we've had a number of developments in the markets. So we've had improvements in market infrastructure. We've seen for example, the establishment of exchanges like the FMDQ, the NAST, even commodity exchanges, the Lagos Commodity and Futures Exchange, the AFEX, the Gazewa Exchange. We've also seen improvements in terms of products. We've seen the introduction of derivatives. We've also seen exchange-traded funds. Even sustainable products like green bonds, have also been issued, Sukuk and the rest of them. So what has become obvious is that the markets, the investment law in Nigeria has not kept pace with, with development over time. And of course, you remember, Rotus, even as recent as last year, the SEC licensed two, cryptocurrency exchanges. So we have seen that development. We've also seen regulations around the crowdfunding. So when you take all that into cognizance, it becomes very clear that the ISA 2007, has not kept pace with all these developments and therefore, needed to be amended, which is why I commend the major actors, in this project, notably the National Assembly committees on capital markets, both at the Senate and the House of Reps, and of course the Securities and Exchange Commission. So it's indeed a worthwhile, development and a welcome one at that matter. Now, if you look at other jurisdictions, by the way, where I work, where I teach, we have a number of students under my supervision that are researching the relationship between, dynamic investment laws and capital market performance. And a priori expectation, has it that, of course, a positive relationship exists between dynamic investment laws as opposed to rigid ones and the capital market performance. And that's what we're about to see, in the case of Nigeria. If you look at South Africa, for example, the principal law there is the Financial Markets Act of 2012. And that law has also undergone a number of amendments, the recent one being 2021. So it's not surprising that South Africa today is, the market is more or less developed, in terms of fairness, transparency, and market integrity. You can also give it to South Africa. Right. The same thing, ditto for India, where you have the Securities, the Contract Act of as far back as 1956. And of course, the SEBI Act of 1992. All of that, too, have undergone several amendments. So it's important that from time to time, in line with IOSCO principle, that these laws are reviewed to keep pace with modern developments.
Fantastic. Now, we have a quote up there. Let's put that back up for the Director General of the Securities and Exchange Commission. It says, by addressing regulatory gaps and introducing forward-thinking provisions, the new act empowers the SEC to foster innovation, protect investors more efficiently, and reposition Nigeria as a competitive destination for local and foreign investors. And I want to bring in the act recognizing digital assets as securities and putting them under the purview of the SEC. Can you speak to that? What's the significance there?
very, very significant in the sense that it, if you like, addresses the issue of regulatory overlaps in Nigeria. Reuters, I'm sure you know that in some jurisdictions, let me use the US for example, the issue of who regulates digital assets, has always been, a source of, a source of regulatory friction, where cryptocurrencies, for example, are considered securities. They come under the purview of the SEC, the US SEC, where they are considered as commodities. They come under the purview of the Commodities Future Trading Commission, and where they are also seen as property. The Internal Revenue Service, comes to regulate them. So you have this, multiple regulatory agencies, of course, which brings about uncertainty. But in the case of Nigeria, it has become very clear now that the law recognizes cryptocurrencies, digital assets, as securities. And where they are securities, they are under the jurisdiction, regulatory purview of the Securities and Exchange Commission. So it's important that that has, that has happened. That will bring about certainty. That will bring about a lot more confidence in the system, and we should expect going forward to see more of these virtual asset service providers, and digital exchange platforms. We'll see more of them in Nigeria, and what that will also do will also be to help, if you like, increase financial inclusion, bring more youths in particular, into the capital market. So I see that as very, very significant.
Now, can you explain the designation of a composites and non-composites exchange categories, and I guess what that means for the markets?
Okay, well, when you say composite simply means the exchange will be licensed to trade, multiple asset classes, different financial instruments, different securities, whether shares, bonds, derivatives. And when an exchange is classified as non-composite, of course, that will mean the exchange will be expected to be dealing with specific security. It could be shares, it could be bonds. Of course, you know that even as we speak, there are the members in the country, which is the NGX, trades not only shares, but also bonds and some derivatives, exchange-traded funds. The FMDQ, we know, is primarily for fixed income, especially for the capital market bonds, both government and corporate bonds. And we also have the NASD, the PLC that is also into shares. So the whole idea is to facilitate regulation. The Securities and Exchange Commission can also come up with sector-specific policies, that mitigate risks. It will help the SEC, essentially in its regulatory function. And on the part of the investors, it will also help in asset allocation. You would find institutional investors, for example, pension funds, be more interested in composite exchanges because, composite exchanges, of course, will have a composite index that will enable them have a general view of the market, market's overview, market trend, as opposed to the non-composites, which maybe a retail investor will be interested in, which those ones, as I said earlier on, more sector-specific. In US, for example, you hear of the NASDAQ composite. In some other jurisdictions, Indonesia, you have the Jakarta composite. So composite simply means you're permitted to deal in more than one asset class, as opposed to the non-composite. It will facilitate regulation on the part of the SEC and decision-making on the part of investors.
Professor, I think my final question to you, what do you make of the subnationals having more flexibility to raise capital in the markets? Does that flexibility mean a little bit looser regulation? Any risk there? What's your thoughts on that?
Well, I think what we have currently is a little more rigid. And I can tell you this from my experience as a former finance commissioner. It's pretty difficult for a number of states, subnationals, to go to raise more funds from the capital market. And that's why you find many of them resorting to banks, resorting to the money market. As we speak, of the 774 local government areas we have in the country, just one of them has approached the market for long-term funds, and that's talking about Lagos Island. So the others have not done that. So there is need for flexibility in those regulations or requirements for subnationals to access funds from the markets. I think Section 226 of the Defunct ISA 2007 provides a cap, and that's where I talk about, that's where for me the flexibility has to come in. There has to be a cap. If you're a state government, you want to raise funds from the market, it says that your outstanding loans and the one you intend to raise must not be more than 50% of your actual revenue for the preceding year. So you have obtained the approvals from your state executive council. You've obtained approval from your state assembly. You have also issued the irrevocable standing payment order. Okay, but you have to also meet these requirements, the requirement that places a cap on what you are to borrow. So if, for example, your actual revenue in the preceding year is 1 billion naira, it means that you cannot raise more than 500 million. So if your outstanding debt is already up to 500 million, that means you can't raise money. So that's Section 226 of ISA 2007, and I'm saying the flexibility we now have should be such that allows subnationals to take more money beyond the 50% cap that has been provided. But the other requirements, I think, are necessary to ensure, just as you mentioned, that there isn't moral hazard. Post-issuance requirements, obligation, for example, requiring you to publish your financials, requiring you to publish utilization of proceeds, requiring you to even ensure that credit rating of the bonds, are reviewed regularly and are published in the national newspaper. I think those ones are necessary, but there has to be flexibility in terms of, as I said, the limit that subnationals are allowed to access from the market.
Professor Uche Uwaleke, thank you so much for your time. Very informative. We appreciate you coming on to talk to us about the Investment and Securities Act signed by President Tinubu. Professor Uwaleke there, of course, of Nasarawa State University.